Well, I took away there was something there for everybody, which is why the shares were initially down 2-3%, then closed up in the after-hours market, maybe up 1 or so percent. You say revenue, we knew was going to be decent, earnings beat, revenue guidance was good for next quarter, gross margins were fine this quarter, looking a little bit soft last quarter, iPad sales good, iPod sales fine, Mac sales good. Yeah, it's a real mixed bag, and to me it tells you that this stock is not far off efficiently valued, and that's certainly why we don't own it.
You got out of it last year, didn't you?
Yeah.
Could you get in again?
Yeah, I mean, the stock is optically potentially quite cheap. And what investors really want, I think, to get excited about the stock is new products. You know, new products can drive earnings estimates higher, and earnings estimate growth will drive the multiple that investors pay for that earnings stream. Absent that, the stock looks pretty fairly valued to me.
New products, I mean, you've got the 5C, the 5S, the new iPad Air, the iPad Mini, a different version. Is it enough, Matthew? Investors, obviously, they want more, don't they? They think often that Apple doesn't deliver in these presentations it has every year in San Francisco. Is it enough?
Well, it's incrementally important, but maybe it's not enough. And let's recall what got people so excited about this stock 2-3 years ago was that Apple created some very large markets that didn't exist. The iPhone, the iPad, these are markets that just weren't there in terms of the tablet market 2 or 3 years ago. So that's why people focus perhaps unduly on television, on the watch, the iWatch potential. Now, these are probably very small markets, but they're new markets, so incrementally they will add incremental profit to this business, which analysts can then re-rate higher.
Do you own any of its peers, the Samsungs, or any of the other Asian competitors?
We do own Samsung, and Samsung has been a very solid performer too, though a lot of their strength this year has come from their dominant position in the DRAM market rather than necessarily on the devices side, where yet again it's been very hard to surprise people because we all now understand the scale of these markets and the margin that can come from these markets.
Talk to me about BP, Matthew. You don't own BP in your global funds, up 6%. Profit could fall today, production falling, refining margins weakening as well. Another company, litigation risks.
Yeah, and for BP, when you look at the stock, there are two drivers here. There is the fundamental issues and there is the litigation. And we've got some very favourable news on the litigation early this month in terms of the court now having to go back and looking at reassessing, redefining how some of these payments are going to be made. But fundamentally, we're looking now to see when the cash flow is going to start coming out of BP. We've gone through a period of significant investment by BP in Angola, the Gulf of Mexico, North Sea. As that capex dwindles, so we'd expect as these projects ramp up, cash flow from these projects to start coming to the fore. And that can potentially drive some very meaningful upgrades to earnings and potentially some very meaningful growth in dividends. And dividends are very important for investors in all shares.
But you're not in there. Why not?
We're not there yet, but I think the stock is quite cheap enough, and certainly the litigation overhang potentially is very significant. I think it's diminishing as a risk, but it's still there, and it's certainly keeping us from investing currently.
Set aside $42 billion. That's the total cost of the bill so far. That's what they've set aside. Thanks, Matthew. You're coming back.